Analyst here at Blueberry. I'm going to be taking you through the charts as per usual. We're going to go over some of the data that has been released, some data that's coming up, and yeah, we'll go from there. So you can see we've got some people waiting already. Ibrahim already waiting. Vincent, good afternoon to you. Never been called a boss before, so welcome. Hope you're doing well, mate. Good afternoon to you as well, Rye Guy. So pretty slow week so far. Let's be real. It's been a very slow trading week, especially from markets that I've been watching anyway. Been looking for a lot of reversals, and sometimes with reversals there can be a very slow build up before we see the turning point. So not really done a lot this week, I must admit, in terms of trading. But we'll go take a look at the charts as usual, go and have a little look about some theories that I have, some markets that I'm keeping a close eye on, and then we'll go through that. We do have a big news week, obviously. It's a lot of labour market data in the US coming out this week, including non-farm payrolls tomorrow. So maybe the market's been slightly hesitant on that front to really get going. Hello to you, Ratish, as well. Irfan, welcome. Hope you're both doing really good today. Right, let's bring on the charts. So I've got the S&P 500 up here, just the futures contract, the E-minis at the minute. Market has been breaking to the upside, broke into new all-time highs on Monday, and since then prices continue to trade higher. I have liked continuations on the S&P, but I haven't managed to kind of get into any moves myself. There was a nice little retest here on Tuesday where the market kind of jumped into the moving averages and then continued to kind of break higher. Really speaking, looking at potentially a break of these kind of highs in here would have been a nice move to see the continuation higher there on the S&P, but this is slowly grinding higher right now. And, you know, actually there's a really interesting volatility index play that comes between Christmas and New Year, where usually the volatility index can jump. So maybe we'll get a bit of a pullback before the end of the year. But yeah, that's the market that's been doing pretty well. Haven't managed to jump on anything there myself. Fran, I've had a tremendous week. Lovely ETH run yesterday and pound yen today in good profits. Like the sound of that. I'm assuming you're buying pound yen and not selling it, right? Because the market has been pushing higher here after it broke through these lows. I'm actually more on the sell side of pound yen. I've been on the sell side since this week here, since the end of last week, really, or the end of the 22nd of November, and I've enjoyed a couple of short opportunities on breakouts, but since then the market has been kind of in this corrective phase. You can see here, you know, market rallied, consolidated. We're just getting a breakout of that, moving back to the upside on pound yen. Pound actually a little bit of a stronger currency on the currency strength for me to going into this trading week, so not really necessarily focus too much on the pound right now. One market that I did like for a potential short was CAD yen, and I'm still kind of watching this one. Haven't set up just yet, but CAD weakness, don't really like the look of the weakness in the CAD at the moment. We do have a COT signal to be short on this, or to be a buyer, sorry, of the Canadian dollar, but we're not really seeing that follow through right now. And if I look at CAD yen prices in particular, you know, there's this little resistance zone that I'm eyeing up around about the 107.50 up to the 108s, with the potential for a move down into these lows in here, around about the 105 handle, somewhere around this kind of area. So looking for a little bit of a fake out or some kind of push into here. We are in the phase 2 here, okay, so the secondary phase of this market right now, which means that on a lower time frame like the hourly, we're going to see an upward trend being formed here, and you can see that quite clearly in this little section here where the market was making lower lows. It then made a higher low. We have had this kind of complex pullback into support, and now we're starting to break out again. So I'm looking for a move up into this kind of 108 handle. If we can get kind of like a double top pattern or some kind of rejection pattern in and around here, I'd be happily looking for a short, because I quite like yen strength at the minute. So I'm trying to look at where I can get on the back of that yen strength and try and capitalize on it. One of those is CAD yen. The other one at the minute, Aussie, seems to be a little bit of a weaker currency as well. If we look at Aussie yen here, we just remove some of these drawings. We had this really nice sort of consolidation pattern up in here. Price has breached that. We've continued to trade lower. Don't really like this price action if I was going to get short. Lots of wicks to the downside. Seems to be buyers coming in on these short-term temporary moves lower. But nonetheless, I like the idea of being short this market. But that to me is not somewhere where I want to short. Thinking in terms of kind of my risk-reward ratio, where do I want to target? Well, I want to try and target probably down at this area of consolidation down here, where buyers stepped in. Where do I want to sell from? Well, ideally, if price could get back into that zone, that would be where I'd want to sell from, because I can get a safer stop loss above the highs there. But secondary to that, very similar to CAD yen, I want to see maybe a little bit more of a push up into a resistance level. We've had this kind of pause day before a continuation, so I quite like the idea of price moving up into this little area here for a continuation. So just kind of sitting on my hands at the moment. Nothing really there for me to kind of do right now across these currency pairs. I just feel like I'm just kind of waiting for a good opportunity. Hello to you, Eddie. One market that I've really been keeping an eye on at the moment is our side of fixed income. Been looking at the sort of the bond market. We can see that the bond futures have now started to break out higher, and we are closing above that daily 50 moving average. So I feel if we're going to see bond futures continue to push to the upside, or bonds in general continue to push higher, then that could be a weaker US dollar. Okay, so just to kind of prove that to you, here we go, grab the US dollar index, just hit the compare tool. You can see that when bonds fall, US dollar rises. When bonds rise, the US dollar falls. So I'm looking for something similar here. We're breaking these key areas on the bond market right now. I would like to see this continue to push higher. The way that is going to push higher is if the market thinks there's a cut coming. Okay, so if we just go to the CME Fed Watch tool and have a little look at what we've got going over here, we are starting to see the market price in a 70% chance that we're going to see a cut on the 18th of December. So really speaking, if that is the case, then we usually do see a US dollar weaker on that, and see bonds kind of rise off the back of that. So yeah, it'd be interesting to see how this does play out going into the 18th of December, because we've got some important data still to come, right? So just to kind of add a little bit of a spanner in the works, we do have some more job data coming up in the US, including the non-farm payrolls, which is forecast to come in a little bit better than before. We had a 12k announcement in October. I imagine that will be revised up. I think 218 is probably where we're going to come in at, maybe just a little bit lower. But I think the revisions here will help the US dollar in the short term. But I'm still on the negative side, because I just feel like that is too obvious for something to happen there. So I'll be interested to see how the market does close on Friday. Whether we get kind of that dollar strength because of the data, but then a close lower on the NFP reports. That would be interesting. Unemployment claims rose today, 1:30 p.m. We had unemployment claims that actually showed a rise there. So I like the idea of seeing a little bit of dollar weakness coming into the market, because we've got bonds moving to the upside. I feel like that jobs data is a little bit of a retail pulling. Do you know what I mean? So that's why I'm kind of interested in being a seller of the US dollar, and we can see at the moment the US dollar here. Let's get rid of that overlay if it'll let me. There we go. Dollar starting to push a little bit lower towards the US Open after that data. So I do like this downside in the dollar in the short term. I wouldn't mind seeing it come back into like the 105s, 104.50s. I think that's where I'd like to see it. Is FTSE on the watch list? There's a good pullback to longs, maybe another tap around 830.10. Yeah, FTSE was on my watch list. There's a strong seasonal pattern on FTSE throughout December. So yeah, I'm actively looking at this, because if we look at it, prices kind of consolidating after a move up. I'm just waiting for a little bit, because we're kind of bottoming out here, which is great. But if we can get some kind of considerable break of something, we did get that break, a retest here. I'm kind of looking to see if price will sort of break into new highs, give me that higher high, higher low pattern, and then I'll look to be a buyer of it. Very similar to what happened here. Can we get the higher high, higher low? Try and look for a bit of a breakout again. We are very close to some resistance, that being all this area in here. So we are very close to that resistance, but there is a case to be slightly bullish from a seasonal perspective. Whether you think that it's going to be long lasting, that's a different kind of conversation to have, because obviously of the new taxes in the UK and how businesses could come under pressure because of it. There's not a lot of stimulus for businesses in the UK right now, so I feel like that would be bearish for the FTSE. At the moment, price is kind of range bound. We're close to these highs now, so any kind of trade that I will apply to this from a seasonal perspective will be very short term. I'll be looking at short term breakouts on these type of markets to the upside. Right, guy, waiting for NFP to see what gold does. It's been consolidating for 8 days now. I think it's going to go to the upside, but I have to wait to see. Yeah, I'm very much in the gold buyer camp. 2 reasons. One reason for that is I think dollar weakness is coming. Not necessarily that means that gold is going to move higher, but sometimes these two markets can correlate quite nicely, and usually when they do correlate, you get the strong performance. So yes, we've been consolidating here. I do like the seasonals on gold. If we just go take a look at those, let's go to metals. Gold, yeah, usually kind of towards the sort of 13th of December, we can get this kind of bottom in price, and the market moves up. Now, we don't have a very sort of strong correlation with all years at the moment, but we have had quite a strong correlation throughout the years. This is one correlation that I've been looking at with the custom format. Usually, like I said, we get that kind of bottom coming in. There's a nice little pattern that forms around about December 13th. It doesn't have many years related to it at the minute on that particular seasonal pattern, so it's not as reliable. But even if we just go back to all years, let's just take off this. Usually, again, around about December 13th, we get this kind of seasonal run up. Now, this does have a lot of data holding it back. This is 49 years of data on this seasonal pattern. And if we go take a look at some of the sort of stats for this, it's usually between the 13th and the 30th of December. It has a 69% win rate, which is, I think, fantastic. I think something definitely worth look at. 34 winners, 15 losses, average return of 1.7%, max profit has been 0.17%, max loss has been minus 4.5%. So if we just kind of have a look at that on the chart and we say, okay, well, where's 1.7% on a sort of breakout of this range, right? 1.7% kind of brings us back into those highs. That's just on on average, right? Obviously the max has been like 14% or something, which is a big move. The max drawdown has been 4.5%. So if we are going to look for breakouts, then 4.5% is pretty much these lows. So that to me would probably negate anything anyway to be a buyer of gold, because if it breaks into new lows, then that's the market kind of telling you that the market is thinking that this market is more bearish, in kind of real time. So I think what I'd like to see from NFP tomorrow is maybe a bullish reaction, a bearish reaction initially on gold, maybe a false breakout, maybe like a breakout, close back within the range. That to me would be like the most ideal setup, because I think we could have a tighter stop loss, and price could move higher. I think if we do just career off and break out, then it's going to be harder to get on a potential move. Maybe we have to wait for some kind of pullback and continuation. But usually gold then goes on and performs quite well through until kind of mid-January, even till sort of mid-February. So really speaking, if we are going to see this gold play out, then we could see it continue to be stronger for the next couple of months. COT reports aren't really showing too much in the way of gold either. It still hasn't been updated. I know someone said that they've seen the latest reports. I went to the CFTC website, downloaded the latest reports, and they're not on there. So I don't know how accurate those other reports are. Because I went directly to the CFTC and I downloaded them, and it was still saying that the 26th of November on it, not the 3rd of December. Actually, it would be that would be the latest report, wouldn't it? 26th of November would be the latest report. So maybe it just hasn't been updated here. Pip King's Academy, if there's so much things affecting the market, how come everything seems to be hanging on NFP and FOMC, especially gold? That's a great point, because fundamentals drive the markets at the end of the day. The NFP data is the biggest data, or one of the biggest data points of the month. Labour market's always going to be the most important piece of data, because an economy performs better in a strong labour market. In a weak labour market, then an economy performs worse. When we look at it in terms of, if you go look at sort of higher unemployment rates and you track when unemployment rates are moving higher, then you'll see that the performance of markets aren't as good in an environment where we see stronger labour market data. So when it comes to things like NFP, yes, we see the market kind of hold around for it, because that can be a catalyst in terms of how hedge funds go and position themselves in the future. I for one think that the market has been aggressively buying US dollars, and they are doing that because they believe that the Fed is going to actually hold interest rates higher, potentially even hike if they need to in the near future, because there's a lot of worry around inflation pressures, especially when Donald Trump comes in next year. So really speaking, how would the kind of NFP affect that? Well, if we do start to see a stronger labour market, that essentially means that there could be more money flowing within the economy, more spending. And at the end of the day, spending is what drives an economy. It's all to do with money in, money out. So if an economy is performing well, you should have a strong labour market. And if you do have a strong labour market, well then, companies will continue to sort of hire people. Profits could potentially go higher, X, Y, and Z. It kind of fuels that sort of GDP growth, I guess, growth within an economy. So the market does hang on to those kind of things, because as well, hedge the way hedge funds kind of position themselves in the market, they can't just lump in orders all the time at specific turning points, because it'll be too obvious where they're doing business in the market. And the way they have to try and trade is they have to kind of aggregate their orders within a market. Otherwise, if everyone knew where the hedge funds were exactly going to do business, nobody would do business with the market. They'd just wait for those moments. So yeah, essentially they can use these types of news events to fill orders that they want to get involved. So, you know, for me, I feel like one market that I really want to take a look at right now is the euro. What if we see an aggressive euro downward move on the NFP data, but then a close higher? That to me would be quite interesting, because looking at the COT reports right now, you know, I'm looking at this thinking that the hedge funds are heavily short euro. If you look across the board, what is everybody talking about right now? It's euros. Europe's in the bin. We've got French elections that have just gone sour as well. We've just got German elections that aren't doing, you know, all crazy. So yeah, you know, that's what I like to kind of look for. Is I like to look for the hedge funds to be, you know, aggressively in one direction, because it can lead to reversal setups. If you go look at the likes of the Japanese yen, this was a really good example of this. There was a lot of talk about intervention coming into the market. Now, if we look at how the hedge funds were positioning themselves into this, you can see that hedge funds were aggressively short. That was back in April. We saw a little bit of a move away from that. Price continued to trade short. They were then at historical short levels, right? So they kind of get to a point where they almost run out of steam, right? It's like, how far can they continue to push this narrative? How far can they continue to kind of push this and get their orders within the market? And it comes to a point where they have to liquidate those positions. And you can see they were at historical shorts right before the turning point and right before the intervention came in by the Bank of Japan. So, you know, that says a lot about how hedge funds can be positioned going into news events. Kareem, the new fire, the approach, Jason Shapiro. Oh, I love Jason Shapiro. If nobody knows who Jason Shapiro is, you should definitely go and check out Jason Shapiro, because he actually trades, or I actually trade in a very similar way, and I didn't know this. So if you read Jack Swagger's book, which is New Market Wizards, Jason Shapiro features in that. Now, I actually only found out about Jason Shapiro a couple of years ago, I reckon. But the way that he looked at the markets is very similar to the way that I look at COT reports. I like to look at where they're crowded. This is exactly what the Markets Make Clear tool does anyway. It shows you when those significant turning points could potentially be. That's why, you know, I use it, because it looks at that. You know, we were looking at sort of CAD futures earlier in the year. We were looking to be long on CAD back in August. Why were we looking to long CAD back in August? Well, if you look at the net positioning, hedge funds were aggressively short CAD futures at levels we haven't seen, you know, in history. If I go back, I can go all the way back to 1980, and you can see they were the most aggressive short they've ever held on CAD futures. You know, at some point that's got to give, and they've got to try and get out of those positions, liquidate those positions. And we were looking at these range lows here for them to do that at. And then we had some data out of Canada. The market tried to break through the lows. It failed, closed higher. Market ran down to the 1.36, might have even been the 1.35s on US dollar CAD prices. We're now seeing something similar again. Price has been moving aggressively lower. This time we've kind of broken into fresh lows, but you can see that hedge funds are getting short at very similar levels. It's not historic levels, but it's coming up to levels where there could be a potential kind of rip back on that. But I would like to see it kind of get to these levels here. You can look at the difference in the long and short contracts. Short contracts have been building up very much at similar levels as what we've seen before as well. So just waiting for them to kind of reach a real significant extreme before trying to get on those. But yeah, if you go and check out Jason Shapiro, I believe his channel is called, I haven't looked at it in a minute. I believe it's like Cot Report. I'm butchering that. Cot Report something. Tell me if I'm right then, Karim. Let me Google him. Because if this is, so, you know, when you look across the internet and you look across people to like watch, you know, and I do this often myself, I feel like you should go and watch people that are actually, you know, in the markets and putting their own money at risk. Now, if you don't know what a market wizard is, that's someone who has like made a significant amount of money trading. It's called the Crowded Market Report by Jason Shapiro. So yeah, go check that out. Talks a lot about COT reports. He's done a lot of interviews recently by the looks of it. So I'll have to check those out after this. But yeah, he uses the COT reports to identify extremes as well. But he's been in the markets for years and years and years. So always good to look at. There's someone else as well that I like as well, Linda Rashke. If you want to look at people, again, that are in the Market Wizard book, go check out Linda Rashke. She does some real good talks as well. So yeah, and she's also was featured in the Market Wizard book as well. But my ultimate favorite person, if you're going to go look at somebody, my ultimate favorite person to look at is Larry Williams. Let me know as well if you guys have any kind of internet trading mentors, because mine is definitely Larry Williams. To me, Larry Williams is obviously one of the greatest traders that has kind of lived. But his approach, also using the Commitment of Trader reports, really inspired me to use the Commitment of Trader reports. Also, Ray Gilmore, who I'm just going to give a shout out to. Ray probably never watches these, but Ray Gilmore, who came up with the software of Markets Made Clear, also was a person that got me into the COT reports as well back in the day. So yeah, this is why I use them so much, is because for one, they use them, but two, I know it works. And you guys know I've been sharing COT reports with you for a good while now. And yeah, I think this is a good one. But yeah, let me know in the comments. Let me know who your kind of favorite ones are to go and watch. But yeah, those are my three: Larry Williams, Linda Rashke, and Jason Shapiro. Yeah, go check out Jason Shapiro. Another one I like as well, I don't know if you guys read trading books or anything like that, but it's Christmas coming up, so you know, maybe you can ask them. This is a book I'm reading at the moment, The Art of Currency Trading by Brent Donnelly. Brent Donnelly is a macro trader, so I always, you know, like to look around and kind of read people's views and opinions on sort of macro trading. I think that helps me get better at what I do, and hopefully, you know, there are some good little nuggets of wisdom in there. Something that I've really enjoyed about Brent's book, and I think I showed this in one of our things before, is the US dollar smile. That's a concept I've naturally never heard of. But that's something when I was reading this book, and it kind of made a lot of sense to me when reading it. So I think that's something to look at. I've actually asked for a book for Christmas, another Brent Donnelly book, because he owns a hedge fund called Spectra Markets, and it's all to do with seasonality. And you know, I'm a big fan of seasonality as well. So I've asked for that book as well. So yeah, fan ours would be John Kibbler undisputedly. Well, thank you. I appreciate that. I did not. Yeah. I appreciate that. It's weird that you guys, you know, watch it, but it's the reason why I do this mainly is because I get so much joy out of everybody watching the content, obviously learning and becoming better, hopefully. That's the goal. That's the aim. That's why I'm here. Because it kind of helps me fill my time when I'm not in any kind of trading positions. So, but yeah, crowded market report. That's the one. I've just Googled it, found it. So crowded market report. Go check that out. If you're into COT as well, honestly, if you want a better detailed analysis of COT reports, they are way better than me at it. They've been using it way longer than I've been using it. They probably know quirks that I don't use. But yeah, you know, that to me is those guys are, you know, have been in the game for a long time and they use that. Larry Williams, I've never actually used any of his tools or anything, so maybe that's something I should go and check out, because I know that he talks a lot about like a sentiment indicator that he does, and it's based off of the non-reportables. So just to kind of give you an oversight of the non-reportables, if you go into this COT extremes, you can see here it says non-reportables. These are basically just like very small speculators in the market that aren't necessarily big enough to actually report it to the CFTC. So that's kind of like retail, essentially, kind of pulled in together. And, you know, typically you want to do the opposite of what these guys are doing, right? Especially when it comes to certain markets, because they usually pile into a trend when it is at the end. So Larry Williams actually built a indicator using the non-reportable positions instead, because it showed him where you could look at different things. One space, however, they are very good at is lean hogs. So you should actually follow the non-reportables on lean hogs and live cattle, because they pretty much get it right over on those markets. Elion Burn Skoropinski on YouTube, supply and demand cotton seasonal trader as well. I've never heard of Burned. Is that how you say it? Burned. Burns Skoropinski. Oh my god, it's the top. It's the top one when you click on it. Let's have a look. FTMO all-time record holder. Verified track record 2 million book, 11 full-time CEO license. Wow. I've never heard of this guy. Supply and demand strategy rules. Let's have a look. Maybe I'll check this guy out after. I can't really say anything. He looks very YouTube-y, but if he talks about COT and seasonality, then that to me sounds good. So yeah, let's dive into a bit more charts. But thank you, Ratish. Appreciate that. There's not really much to go over. Like I said, I was looking at the currency strength meter for this week. You know, I like the idea of being a buyer of Kiwi CAD, but when we had a look at it, it hasn't quite set up yet. So if I just have a little look at Kiwi CAD, you know, we're still below the daily 50 moving average. So although I quite like the setup here in terms of that's a potential inverse head and shoulders, you know, there's a potential for that to happen. I haven't got the setup just yet, so keeping an eye on that one. Pound yen I've been short of, but not a fan of this time around. CAD yen I quite like to the downside, but we've already kind of discussed how I feel about this market. You know, I want to see it kind of push into this area first before seeing a bit more downside. Just this kind of area of supply there, which I'm interested in getting involved with. Aussie yen I quite like as well, but I need to see this come up as well, maybe up into that kind of 97, 98 kind of area too. But I'm really kind of focusing on this US dollar reversal setup. Euro's looking pretty good to me right now. You know, we've got this nice little big extension outside of here now. Daily chart, it looks like this inverse head and shoulders is starting to build up a little bit. You know, maybe if we can get that breakout, we can see that move up to the 1.08. So like trend traders, obviously the market is still technically bearish for you, but once you get that breakout higher low situation, then that could look pretty good. Cable's starting to look good as well. We've actually had a breakout of a high. I've been watching cable a little bit because there's a good chance we could probably trade back up into the 129s. You know, if I look at it, and you can just clearly see that consolidation there. If I just put a volume profile on it, you can see all this build up in here on the terms of volume. So, you know, to me, this zone in here could be somewhere that cable goes to target. So I quite like that. Supply and demand playlist is so good. Okay, I'll check that out. Right, guy, I'm looking at pound. Okay, so yeah, pound dollar to the upside. Also, Euro Oz from 164. Yeah, I quite liked the idea of being a buyer of Euro Aussie. I was watching this price action here on the daily chart, and that to me looked really good for a continuation to the upside. I haven't taken anything here. You know, daily chart was looking pretty good, but I had this kind of crossover happening on the stochastic. Now we've got this nice extension up there. You can see, look at that nice little breakout in pattern there. Consolidation breakout earlier today. That would have been a nice breakout, you know, trade to go and take with a move up towards the 166. But yeah, I quite like the idea of being a buyer of Euro Aussie as well. You know, this is where we kind of look at it and say across the board, okay, Euro, there's a COT signal long. How can we go and trade that against currencies that are getting weak? Aussie's one of the currencies that is getting weak at the minute. Another one of those is CAD. So, you know, Euro CAD could be a mover to the upside at the moment. Kiwi's obviously been a weaker currency. I like the idea of being a buyer of Kiwi, especially against the US dollar. But I can see why, you know, you want to focus more towards the euro at the minute. I don't know how it's performing against the Swiss franc. Swiss franc also a little bit of a stronger currency right now. So Euro Swissy is right down at this support. So yeah, maybe I wouldn't go looking too aggressive on this market in general. But yeah, that's how, you know, that's how I like to look at things. We can look at sort of the euro COT signal. If that is going to get, if that currency is going to get stronger, what's it going to be stronger against? Currencies that are getting weaker. I quite like the idea of dollar getting weaker because of the bond market and the situation on the bond market. Can I look to try and capitalize on something like the euro, something like that, right? That to me makes a lot of sense. You know, I quite like the idea of dollar CAD breaking lower as well, but I'm just kind of waiting on dollar CAD right now. You know, we do have this quite large sort of hourly area of consolidation that has been broken through in the past couple of hours. So I was watching that quite closely. But I mean, look at this dollar move. Dollar's obviously moving a bit to the downside right now. And if I just quickly flick back over to gold, it's not moving. Not moving right now. Super interesting, that market. But yeah, I'm just focused on dollar selling at the minute. And, you know, dollar yen also. So Ibrahim, what about dollar yen? Fantastic. Yeah, I like the idea of being a seller of dollar yen. I like the idea of buying Japanese yen at the minute. Market has come up into this area of resistance. So it's had a sort of one rejection. I'm just kind of waiting here for a change of trend. So for me, I didn't mean to do that. For me, what would that look like? Well, you've got this kind of downward move here, right? And then price has broken to the upside. Then we've got this higher low. So if I'm being honest, I want to kind of see like a break and then something like this happen. But, you know, I'd be watching these kind of lows on the 4 hour. I think if the 4 hour starts breaking back to the downside, then I'd be happier being a seller of US dollar yen right now. But I think a lot of these dollar markets are starting to set up. They're starting to set up. It's just how do we go about, you know, trading that US dollar weakness at the minute. If there's an expectation for the Fed to increase rates, that's a bullish expectation for the dollar, yes. In theory, yes, but I think what the problem is with that statement is it depends how they go about this. Now, they are not, just to put that on the table, they are not hiking interest rates, and they are not going to pause interest rates, right? When we had a look at the CME, Fed Watch tool, which is going to be your tool to really have a look at where the market's pricing this in, you know, there is a 73.8% chance of a rate cut on the 18th of December. Now, if things suddenly change, let's say NFP on Friday, we get a stronger job number, which is expected, but we see an average hourly wage increase to 0.4, 0.5%, but then we see a unemployment rate that comes down from 4.1% to like 3.9. That would be a very aggressive switch in what's going on in the markets. Now, obviously, you have to take into consider inflation pressures as well, and inflation has been quite sticky in the US. So there's more chance of them sort of holding interest rates rather than hiking. They are definitely not in a hiking cycle. They are in a cutting cycle right now. And that I don't see them going into a hiking cycle unless inflation really starts taking off. Okay, so one market you might want to go take a look at is US states. So this is the interest rate. Let me just go to inflation. United States inflation rate year on year. I'm going to go to that market as well. And what I'm going to do is just add the US interest rate onto here. Okay, so really speaking, what you get is when inflation starts taking off, that puts pressure on the Fed to hike interest rates. Now, there's one more thing that you should really look at, and that is the 2-year bond yields. Okay, so this is what's known as the short end of the curve when it comes to yields, right? So typically the Fed will kind of follow what's going on the bond yields, right? So when you see bond yields that were starting to fall recently, which is this purple line in here, bond yields were starting to fall, and you can see that the Fed started to cut interest rates, because what we're basically seeing is that the 2 years are pricing in around about 4.5% on the interest rates. Okay, and that's where you're kind of expecting the interest rate to be around. So that's why we're more looking towards seeing a further ease from the central bank, from the Federal Reserve, to try and bring it in line with the way the sort of bond market is looking at the sort of where the interest rate should be. Okay, and you can see here what really goes first is the inflation rate, right? So the inflation rate is the black line. Once the inflation started really picking up, you can see that after that, what happened? 2-year bond yields started to rise as well, because expectations was that rates were going to be increased. Okay, and then it took a little while before the Fed started increasing rates. So what you need to really keep an eye on is the inflation rate. At the moment, the inflation rate has been coming down. Okay, that is why we're starting to see the fact that bond yields, right, are falling as well, and then we're starting to see the Fed cut. The problem with this is, this is the problem, when you just kind of look at macro just like this as kind of one static thing, you've always got to try and think of what's coming up in the future. Okay, and that's what bond yields, or bonds, do very, very well. Is when somebody is purchasing a 2-year bond, they are fixed in that bond for 2 years. Okay, when you've got a 10-year bond, so it says 10-year maturity on the bond, right? And typically what you want to see, or if you are a bond investor, right, you want to get more money back essentially from the higher bonds, right? Or the longer term bonds, because you're investing your money for a longer period of time, so you want a bigger return back for those. And And there's scenarios where you get like an inverted yield curve, and that's basically where you've got the short end of the curve that is more expensive than the higher end. And that causes situations like the recessions that you see within the markets. But really speaking, if you're looking at how interest rates are going to be played going forward, you need to take a look at your bond market. Usually they'll start pricing the idea of a rate cut or a rate hiking. At the moment, we've seen them pricing in cuts. The Fed will follow that naturally. The only thing that's going to change this really is if inflation starts to move higher. And that could be caused by lots of different things. Energy prices going higher could be one of those, because that's directly passed on to the consumer. The second one could be Donald Trump coming in and his policies and the idea of him adding tariffs onto every other country. That could be inflationary as well. But the problem is we don't have the data yet. So we can't, try and prejudge it right now. It's only kind of our opinions of what could happen in the future. But you can't really trade an opinion. You can have an opinion on the market. Can't really trade an opinion because I don't think that would be very successful. What you have to trade is what's happening right in front of your face, which again is kind of why I use like COP reports, seasonal reports, things like that. Is because that's data. Seeing bonds move higher, that is potential for the yield to move lower. So think of a seesaw effect, right? So you have bonds and then you have the yield on the bond. Okay, as a bond rises, the yield falls. Okay, as the bonds fall, the yields will rise. All right. So, essentially, in that sense, the US. Let's just take a look at we're talking about the US. So, if you look at the US dollar, and you put a comparison side by side of bond yields and the US dollar index, as bond yields rise, the US dollar rises because people are getting more for their yield, right? More for the bond. So they're getting more in return. So essentially, they're buying more of those bonds, which then influences foreign currency purchases. So that's a really long-winded way of saying you should follow these three charts, really. Keep a look at your bond yields. This is something that I look at regularly. You can see that I've got a tab over here on the futures market called fixed income. That's what you should be really focused on, what's going on in the bond yields. You can actually, I've seen somebody make kind of a bond yield tracker before, where you can take the bond yields of kind of every currency. So you can see I've got US bond yields here, but you can go and check out the euro, the UK, or the gilts in the UK, Australia government bond yields. You can kind of potentially make a strength and weakness calculation from all of that. But yeah, 2 year is the short end. That's what the Fed focuses on. 10 years obviously is a bit more midterm. 30 years longer than that. They kind of follow a very similar path when you look at them side by side, but you can have these times when they invert, right? So if I go to let's get rid of some of these lines off of here. If I go to here, for instance, hit regular area. I want to bring that up to 0. So this is the 10 year, right? Minus the 2 years. Okay. And the reason why people look at this, because this is what they call sort of an inverted yield curve. Okay. Which is this one here. These moments. Okay. Now, if I was to overlay the S&P 500 with this, I've actually got a video coming out about this. So that's coming out very, very shortly. But essentially, when the yield curve inverts, it is a sort of great recessionary indicator. Okay, so you can see back in 2000 we had the yield curve inverting. It then came back through, and then it preceded a recession essentially. So this is the S&P 500, which is the purple line. That was the 2001 financial crash. Then we had this one here where we had an inverted yield curve. Market then reverts back. Okay, so it's more important to look at it when it reverts back, because then that also led to a economic crash. We had a inverted yield curve, and it was actually one of the longest that we've had in history. The only other longer one that we've had was sort of in the 80s, and again there was a market crash in the 80s because that was when inflation went ridiculous and the Fed basically hiked interest rates at ridiculous levels to force an economic crash. So yeah, you know, what's concerning to me at the moment is this, right? We've come back above the threshold, and look where the stock market is at the moment. It's rallying higher. But yeah, essentially you need to kind of take all of these things and put them together. Why only the 5-year T-bill is the opposite to the US dollar, and like 10-year bonds and other bonds? Yeah, no, the other bonds are as well. The only reason I was showing you the 2-year notes last week was because there's a commitment to trader signal on the T notes. So when I was looking at the 5-year T notes, it's because, yeah, basically we've got this very aggressive bullish signal on the 5-year T notes. But if you overlay the T notes with the US dollar index, it's the same thing as bonds. Treasury notes are the same as bonds, but they're just a little bit different in terms of their maturity length. Yeah, you're welcome. I think like yourself, NFP, gold will probably fall for NFP. Yeah, well, we have to wait and see, right? I think, you know, for me, we can say, you know, I can give an opinion on what I think is going to happen with gold prices. You know, it doesn't mean it's going to be right, for one, but two, yeah, it doesn't mean that the outcome. It just basically, what I'm saying is almost like what I'm looking for. I want to be a buyer of gold because I believe that the US dollar is going to be a weaker currency. Okay. I also believe in the seasonal pattern that we have on gold. So, you know, I like the idea of being a buyer of gold. Can I go and buy it because, you know, right now? No, not really, because the technicals aren't really there. You know, my timing, and that's what the technicals is for me, is time in the market. So if price breaks out, fantastic. It's kind of, everything's kind of lining up for me then, and it will give me greater confidence going into that trade. Gives me better areas of risk management to have a little look at. Doesn't mean it's going to happen, right? You know, we could come and sit in this stream next week and you can be like, John, what you said didn't happen, and look what happens to price. That's fine. You know, I'm willing to be wrong. But, you know, if we do get that seasonal pattern play out, then we could see price spike up back into the all-time highs, and that would be a great trade to end the year on. So that's what I'm kind of looking for here with gold, looking to see if we get that seasonal pattern play out, can we then, you know, benefit on any kind of moves there. Let's flick back. Dollar starting to give back a little bit of that move. We are coming into these daily lows on the dollar index, which are these highs here on the euro US dollar. So I would expect some kind of give back a little bit from that point. But yeah, like I said, I'm very much just focused on what's going on in the US dollar space right now, especially looking at a lot of these signals, you know, CAD, Euro, Kiwi. Kiwi is probably the little bit of the stronger one because it's got the 100% on the 6 month. This is where I was talking about the treasury notes. So 5-year treasury notes, we've got a very strong buy signal, but we have had this signal for a while. It's just that we are now seeing hedge funds selling T notes at levels that we haven't seen in history. And when that happens, we usually see a pullback in price. And if this does snap higher, then bonds are going to go higher and the dollar will fall. But we need to see it happen. We need to see it unfold, really. But that's what I'm kind of looking for on those. Natural gas is also an interesting one. We're starting to see a pullback on natural gas, but a lot of a very strong bullish signal. Natural gas prices back into these levels. So quite like the idea of maybe looking at a natural gas long, but again, what is the market doing at the moment? It's trending down on this 4-hour time frame. Daily time frame is bullish, which is fantastic. But really speaking, if I'm going to see the daily chart move higher, then I need to see the 4-hour do the same. So I need the 4-hour to make higher highs and high lows in order to be a buyer of that market. I'll tell you where it's gone a little bit quiet. It's gone a little bit quiet on the whole China front, hasn't it? In terms of any kind of significant advances there. You know, I was looking at the Hang Seng, or the Hong Kong 50 index, and we're still in this little bit of a range here, right where we had this pause in the market. So from a technical position, you know, this to me looks like a good little point for a turnaround. You know, it's like a little inverse head and shoulders coming in here. Now, obviously the stimulus from China hasn't really come about, and the market has been calling China's bluff on that stimulus. But if we look at how devalued this market is, you know, from a value point of view, it might be worth having a look at, because if they do start to add stimulus, then, you know, it could be great. So I'm going to look at a potential breakout idea there in China. I know the manufacturing PMIs weren't particularly great, but they haven't been that great for a minute. So Tunji, what fundamental website do you use? And please, can you create a community to teach us fundamental analysis? Potentially. That might take a lot of time to do that, but I appreciate you asking that question. I have a lot of fundamental stuff on the channel, so if you do want to check out fundamentals on the channel, go and check them out. I use trading economics as a lot of my sort of analysis. So if you go to tradingeconomics.com, they do some really good breakdowns of what's going on in each market. I also kind of look at this table here, right? So this table shows us the GDP, gross domestic product, GDP growth, which is super important because that shows you how well an economy is growing, essentially. Interest rates, inflation rates, jobless rates, that's your unemployment rate. You don't really need to know government budget and debt to GDP. A lot of people make a lot of fuss over debt to GDP, but that has been growing for so long. I don't really take too much notice of that. But I think if you're going to start somewhere, if you're going to start somewhere with fundamental analysis, first of all, go understand interest rates. How do interest rates work and how are they impacted? Because a lot of the FX markets will move on the differential between interest rates. For a long period of time, the Japanese yen was being sold off because there was a great carry trade there. So, you know, people were buying sort of, or the way it would work is people would go and borrow Japanese yen at a very low interest rate and go and buy a currency that has a stronger interest rate. So, for instance, the United States, they would go and borrow a load of yen, buy a load of US dollars, and then they'd benefit from the carry rate there. And that's why we saw dollar yen move higher so much. Problem is, you kind of get to a point where it's not beneficial for Japan, for instance. The costs of products in Japan wasn't good for them. It wasn't good for their people. So they had to do something about it, and they intervened to kind of level the playing field again. So the carry trade isn't really there right now, but it can be explored in different areas, like let's say Europe and the UK. Euro pound has been moving down. So, you know, again, what would you do? You'd go borrow the currency that has a low interest rate and buy the currency that has a high interest rate. UK has a higher interest rate than the Eurozone at the moment. That's why we're seeing Euro pound move lower as well, essentially. So if there's one place to start, go start on interest rates, then inflation rates, because the interest rate will move because of inflation pressures. So if inflation's too out of control, the interest rate is a tool that a central bank can use to try and cool the economy. Or if inflation's too low and it goes deflationary, that means the cost of goods and services start to move lower. Then essentially they can cut interest rates and stimulate the economy. So that's something to look at. GDP is also a big one to have a little look at as well. Shows you how how an economy is performing. I mean, look at India's GDP here, 1.3 on the GDP growth rate. You might think that that's not great, especially when you look at sort of a 10-year average and max average. But when you go and compare it to others, it can be considered better, right? Look at the GDP growth rate in the euro area, 0.4. So, people might go and look at India as a potential investment as well. So, yeah, if you're going to look at anything, just come and have a little look. Just research interest rates, inflation rates, GDP growth, unemployment rates. What else can you have a look at? Bonds. Definitely go and have a look at bonds. Try and understand what happens to bond markets. I think if you have those as a basis of your fundamental analysis, then you can go from there and you kind of move on. Fundamental analysis is giving a headache. Yeah, another one though as well, Brent Donnelly. He has a macro trading fund as well. So I go follow people like this, look at what their opinions are on the markets. Helps me understand as well what's going on. But ultimately you can do other things as well. You can do economics courses. There's loads of free stuff on YouTube about economics just to kind of learn how the machine works. I did economics courses because I essentially wanted to understand how everything works. And it's even like this Yeti mug I've got, there's economics involved in this. Someone had to produce it, someone had to someone had to create the color that goes on the bottle, and that's all economics, and someone then pays for that. That all then relates to things like GDP and whatnot. So I'm a little bit nerdy when it comes to trying to understand the market, but for me, understanding it gives you a better picture of what could happen next, X, Y, and Z. Right. I'm going to call it there. It's been an hour and 4 minutes. I usually run for these for about 50 minutes to an hour now. So I'm going to call it there. But yeah, try not to get too overwhelmed with your fundamental analysis. If there's like I said, if there's anywhere to start with interest rates. Understand how interest rates work, how they impact the market. TradingView is really good for just kind of like playing around with charts. I would say, if you want to check out how the inflation rate moves with oil prices, right? How exciting is that? Go to inflation, United States inflation rate, right? Click on that market there. Go to your oil prices. Let's grab WTI oil. Add that to compare on the chart. Go pin that scale there. Look how oil prices relates to the inflation rate. That's just how I look at things. Yes, that is very true. The interest rate is not moving every day, but bonds do. The bond market does move every day, and the interest rate will be priced in what's going on in the bond market a lot of the time. So check out your bonds. Karim, thanks. Thank you to you. Yeah, I'm going to leave it there. Thanks for all the great questions today. There's a lot of new people in the chat, which is great. So thank you for joining me today. I hope you enjoyed the content. If you did, please leave it a thumbs up. Subscribe if you are new to the YouTube channel. I do these live streams every Tuesday and Thursday, 2 p.m. GMT. So I look forward to seeing you there on Tuesday. Have a great weekend, and I will speak to you very, very soon. Thank you.